Professor Nam-Yong Lee's long commentary, How Far Can the Share Price of Google Alphabet, the Heart of the AI War Go? Hello, this is Professor Nam-Yong Lee's long commentary. In this commentary, I would like to reconstruct the share price outlook of Google Alphabet, the leading artificial intelligence company among America's big tech leaders, not as a simple stock tip, but from the perspective of systems and relationships. The share price of Google is the outcome of a vast relational network tightly connecting search and YouTube, cloud and AI chips, regulatory actions by the US federal government and digital policies of countries around the world, and even the one-denominated assets of Korean households. By drawing on global standards and world best practices, the US federal government's FEA framework of 4 business areas and 39 lines of business, as well as domestic and international statistics, I intend to diagnose Google's systemic position and present sober 3-year long-term and 6-month short-term share price scenarios. I wish to state clearly that this commentary is not investment advice recommending the purchase of any specific stock, but a relational and philosophical analysis intended to warn against ignorant, incompetent and greedy investment behavior and to guide and enlighten the judgments of citizens and investors. The big tech system war. Why should we watch Google's share price? In the system wars of the 21st century, the battlefield is shifting from tanks and artillery to data centers and algorithms. We now live in an era where the companies that dominate search, video, cloud, and AI platforms can shape a nation's public opinion, education, industrial productivity, security, and even its capacity to wage war. The company standing at the very center of this battlefield is Google Alphabet. Google is no longer an internet company with just a search box. Google is a core infrastructure enterprise of the digital system that controls the global flow of information and advertising, cloud infrastructure, the smartphone ecosystem, autonomous driving technologies, and even robotics. Governments, businesses, and citizens around the world consume information through Google Search and YouTube, store and analyze data through Google Cloud, and handle movement and payments through Google Maps and Android. To look at Google's share price is not merely to look at the price of a single company, it is to read the direction of this vast digital system. From the perspective of the Korean people, Google's share price carries another layer of meaning. As the value of the Korean won wavers and household assets flow into US equities and dollar-denominated assets, big tech firms such as Google are becoming symbolic safe havens. To invest in Google is therefore not simply an act of seeking profit, it is an act of tying one's retirement and household finances to the system of American big tech. If investors follow this trend blindly, without properly understanding this relationship, we may once again face a collective financial disaster. How Google makes money, the triangular engine of search, YouTube, and cloud. When we view Google's revenue structure from the perspective of networks of relationships, 3 major pillars emerge. The first is search advertising, the second is YouTube advertising and subscriptions, and the third is cloud and enterprise services. These 3 pillars exchange data with each other, share AI models, and bind users, advertisers, and corporate clients into a single enormous triangular engine. Search and YouTube remain Google's core cash generators. Billions of people around the world type questions into the search box dozens of times a day and watch videos on YouTube, while advertisers pay to buy their attention and time. In this process, Google uses AI-based precision targeting and automated bidding systems to raise advertising efficiency and extract more value for both advertisers and the platform. On the surface, search and video look like free services, but in reality, data, time, and attention are all being converted into money. The third pillar, Google Cloud, has now become Google's second growth engine. It was once a loss-making business, but as companies, governments, and startups around the world migrate their data and begin running AI workloads, Google Cloud has entered a phase of high growth and profitability at the same time. Google transfers the technologies and infrastructure accumulated in search and YouTube into the cloud and then sends back the AI infrastructure proven in the cloud to search and YouTube, creating a virtuous cycle. The stronger this cycle becomes, the more Google's profitability and systemic influence grow together. The AI infrastructure war, the strategy of Google Cloud and TPU, Tensor Processing Unit. In the AI war, what is visible on the surface are services such as chatbots and image generators. However, the real battle is being fought in the invisible infrastructure. Ultra-large data centers, ultra-high-performance GPUs and dedicated AI chips, ultra-fast networks, and the cloud platforms that integrate them are the key to victory. Google is plunging deep into this infrastructure war on the back of its own AI-specific chip, the TPU, and a global data center network. In the global cloud market, Google Cloud is currently evaluated as the third largest provider. In terms of market share, it ranks third, but in terms of growth rate and AI infrastructure capabilities, it is one of the most aggressively advancing players at the center of the battlefield. Google has built a structure in which it rents out dedicated chips and massive computing resources for AI model training to cloud customers, thereby enabling corporate clients to develop and operate their own AI services. When we look at the scale of Google's capital expenditures, we can feel the magnitude of this war. Every year, tens of billions of dollars are poured into data centers, AI chips, fiber optic cables, and power infrastructure. This is comparable to the level of social overhead capital investment undertaken by a nation. A single private company building and operating infrastructure on a national scale is the new face of 21st century system warfare. If these infrastructure investments succeed, Google's share price will be re-rated not as that of a mere advertising company, but as that of a global AI infrastructure utility. Google by the numbers, the reality of revenue, profit, and valuation. Let us now examine Google's system once more through numbers. Over the past few years, Alphabet's annual revenue has been estimated at around the mid-$300 billion level, with net income near $100 billion. It has maintained an ultra-high profit structure, with net margins rising into the high 20% range. Such profitability is almost unimaginable for traditional manufacturing, banking, or telecommunications. The source of this profitability lies in monopolistic network effects and data, as well as cost reductions and automation driven by AI. Looking at valuation, Alphabet's price-earnings ratio has generally moved between the high 20s and around 30 times earnings. This is more expensive than traditional value stocks, yet not easily dismissed as pure bubble territory once growth is taken into account. The crucial point is that this valuation is not a fixed figure. It fluctuates greatly depending on interest rates, regulation, expectations for AI-driven growth, and bubble debates. Even if the company produces the same earnings per share, the share price can swing by double-digit percentages depending on whether the market assigns a multiple of 18 or 30. Long-term earnings growth forecasts commonly fall in the range of roughly 10 to 16% per year. If this range materializes, Google's earnings in 3 years could be about 1.3 to 1.5 times higher than they are today. However, higher earnings do not automatically translate into the same pace of share price growth. Depending on the system, regulation, and competitive landscape, the market may compress the company's valuation or, conversely, grant a premium. Google and the national digital system through the lens of FEA and relational philosophy. The U.S. Federal Enterprise Architecture, FEA, divides government functions into several reference models, services, business, data, applications, and technology to design the state as one enormous enterprise. Within this framework, Google is not merely a private platform, but a digital infrastructure provider deeply involved in government financial management, administrative services, citizen communication, and even defense and security. It is now commonplace for national e-government portals, online civil complaint systems, and public data analytics to run on Google Cloud, while policy messages are delivered to citizens through YouTube and search results. From the perspective of relational philosophy, Google's essence does not reside in individual objects such as the search box or the YouTube app. Google's real power lies in the density and direction of the network of relationships that citizens, businesses, governments, media, finance, education, and security systems maintain through Google. Citizens find information through search and consume news via YouTube. Businesses meet customers through Google advertising. Governments convey policies via YouTube briefings and search results. All of these relationships are mediated and coordinated through Google's servers and algorithms. Ultimately, to watch Google's share price is to observe how this network of relationships is being designed, strengthened, and regulated. US and European antitrust policies, content regulations, privacy rules, and each country's digital tax policies directly affect Google's profitability, growth rate, and valuation. When Koreans invest in Google, they are choosing where and at what weight to position themselves within this international network of relationships. Drivers of Google's share price, AI momentum, and structural growth. The drivers of Google's rising share price can be distilled into several key pillars. First, AI continues to enhance the efficiency of Google's existing cash cow businesses, search and YouTube. By using AI to optimize ad impressions, clicks, and purchase conversions in real time, advertisers can achieve better results with the same budgets, while the platform can secure higher unit prices and profitability. This creates a structure in which, even amid economic fluctuations, advertisers do not easily leave. Second, there is the rapid growth of Google Cloud. As companies and public institutions around the world move their data to the cloud and adopt generative AI, demand for cloud services is shifting from simple storage to AI infrastructure. Google Cloud is striving to differentiate itself from competitors by offering AI-specialized infrastructure, development tools, and model services. If this strategy succeeds, the cloud business can become Google's second and third growth engines, driving both its earnings and share price. Third, there are new revenue sources, such as AI chips. Google's in-house TPU and future AI accelerators may reduce internal costs and improve performance, and for external customers, they may become independent revenue-generating businesses. Semiconductors are a highly volatile industry, but AI chips are expected to have a certain level of entry barriers and relatively durable demand. If Google secures a stable position in this domain, the market may reevaluate it not as a pure software company, but as an integrated AI platform enterprise that combines software, hardware, and infrastructure. The shadows on Google's share price, regulation, competition, and bubble risk. Yet wherever the light is strong, there are always shadows. The first shadow is regulatory risk. The United States and Europe are pursuing antitrust lawsuits and sanctions targeting Google's search, browser, and advertising platforms. Criticism is mounting that search, Chrome, YouTube, and Android are overly tied together, and regulators in various countries are repeatedly raising concerns about data monopolies and abuses of market power. If forced business breakups or restrictions on advertising were to become reality, the current level of profitability could be structurally shaken. The second shadow is competition. Microsoft and OpenAI, Amazon, Meta, and Chinese big tech companies have all joined the AI and cloud war. Microsoft has deeply integrated AI into Office, Windows, and GitHub, while Amazon is building its own AI ecosystem by combining e-commerce data with AWS. As competition intensifies to secure top talent, customers, and partners, Google may have to spend more on personnel and marketing, causing margins to deteriorate. The third shadow is the bubble debate. During the height of the AI boom, the share prices of big tech companies, including Google, surged in a short time. If the commercial value of AI is realized more slowly than expected, or if economic slowdown reduces demand for advertising and cloud services, the market may demand a sharp adjustment in valuations. For Korean investors, there is the additional risk of suffering both share price declines and exchange rate losses as the $1 rate fluctuates. If people are intoxicated by the word AI and naively mistake Google for an unconditional safe asset, we may face a digital financial crisis of a nature different from the foreign exchange crisis of 1997, diagnosing Google's share price scenarios 3 years and 6 months. Let us now organize the concrete share price outlook that many viewers are most curious about into relational and philosophical scenarios across 2 horizons, 3-year long-term and 6-month short-term. First, let us be clear about the assumptions. We assume that Google Alphabet's current share price is hovering around the $300 level. Analysts' 12-month target prices are on average somewhat higher than this range, but spread very widely from roughly $200 on the low end to the low $400 range on the high end. This means that even among experts there is substantial disagreement about the short-term direction. The 6-month horizon is dominated less by a company's structural earnings than by sentiment and news. From the perspective of relational philosophy, we can consider 3 scenarios by examining the relationships among Google, US big tech, AI bubble debates, interest rates, and regulatory news. In the negative bear scenario, AI momentum weakens, the NASDAQ enters a correction, and regulatory issues are highlighted. In this case, Google's share price could fall by about 10 to 20% from its current level into the $255 to $285 range. In the neutral base scenario, earnings meet market expectations, AI hopes and regulatory concerns offset each other, and interest rates do not rise sharply. Here, Google's share price is likely to fluctuate modestly around current levels, roughly between $300 and $340. In the positive bull scenario, Google Cloud and AI infrastructure orders significantly exceed expectations, and the market revalues the AI chip and infrastructure businesses. Under this scenario, the share price could move into the $340 to $380 range, representing roughly 7 to 20% upside from current levels. In the 3-year horizon, earnings and the direction of the overall system matter more than sentiment. As noted earlier, if Google's earnings per share grow at an annual rate of roughly 10 to 16%, its earnings in 3 years could be around 1.3 to 1.5 times higher than today. The key question is what valuation the market assigns at that time. In the negative bear scenario, regulatory pressure and intensifying competition lead the market to apply a lower price-earnings multiple to Google. In this case, the share price in 3 years may lie in the $255 to $300 range, roughly flat with or up to 20% below current levels. In the neutral base scenario, earnings grow at around 10% a year and the market maintains a valuation similar to today. Under these conditions, Google's share price in 3 years could fall in the $380 to $445 range, representing a 20 to 40% gain. In the positive bull scenario, earnings grow rapidly at around 15% a year, and the AI infrastructure and AI chip businesses receive additional valuation premiums. Here, one could imagine a share price between $445 and $540 in 3 years, corresponding to a 40 to 70% increase from current levels. A warning and strategic suggestions for Korean investors. What matters here is that these numbers do not describe a predetermined future. They are scenarios that shift depending on networks of relationships. Over the next 6 months, Google's share price will be heavily influenced by external variables such as US interest rates, overall market sentiment toward big tech, AI bubble debates, and regulatory news. Over the next 3 years, it will be determined by the pace at which Google's cloud, AI infrastructure, and chip businesses generate real cash flows, the strength of regulations in the United States and Europe, and global economic conditions, the advertising market, and IT investment cycles. To worship Google blindly by looking only at the numbers is simply another form of collective gambling. From the standpoint of relational philosophy and FEA, investors should design their own lives and households as small enterprises, within an integrated structure that includes cash and deposits, bonds and equities, domestic and overseas assets, real estate and pensions, health and education costs, and even the next generation. They must calmly calculate what proportion of their portfolio should be allocated to Google and US big tech. To neglect this design work and instead be swept along by profit screenshots and trendy buzzwords circulating on YouTube and online communities, pouring everything into Google and big tech, is the very image of the ignorant, incompetent, and greedy investor. When such herd psychology accumulates, it ultimately comes back in the form of national currency crises and financial crises. I dare say to the public and to viewers, Google is indeed the heart of the AI war and a core node in the global digital system. But no matter how excellent a company may be, it must never become the entirety of your life. What truly matters is not any single stock, but how you design and connect your life, your household, and the entire national system in a balanced way. The 3-year and 6-month Google share price scenarios are merely reference values that occupy a small corner of that grand design. If you keep this in mind, you are already halfway to becoming a winning investor. Thank you for watching Professor Nam Yong Lee's long commentary.